Welcome. This is Lab 11.3. The bonus question, it only shows 25 points, but there's a lot of work involved, so I'm giving you essentially double the points for this one. So it has double the weight of the other question in the other questions in this week's lab, or in this chapter's lab. So here we are producing a statement of cash flows from an adjusted trial balance. So they haven't actually shown that it balances, but we'll assume it does. And we've got a number of different accounts, including equipment and machinery, and accumulated depreciation equipment, and accumulated depreciation machinery, depreciation expense for both equipment and machinery. So in this statement of cash flows, we actually have to do the reconciliation of equipment and machinery to determine what the gain or loss is, because the revenues include gains, the other expenses include losses. We actually have to do a number of different calculations to determine the amount of the gain or loss on the sale of equipment and machinery. So let's get started. We're told that they began operations on January the 1st of 2013, which was a little while ago, and now we've got December 31st, 2014 and 2015 balance sheets as well included in the adjusted trial balance here. So the beginning of the year is December 31st, 2014, well, January 1st, 2015, and the end of the year is December 31st, 2015. So we're to assume that all accounts have normal balances, so there's no surprising debits or credits lurking in there anywhere. And we have a long-term notes payable. It says that that will be paid during 2016. That would be important information if we had the balance sheet. But essentially, in this case, it would be a note disclosure to show that the long-term liabilities are going down when the current portion of long-term debt is going up. On the balance sheet, you'd actually have to show the current portion of the long-term debt, but that doesn't impact our statement of cash flows. Equipment was sold for cash of $24,800, so that's the proceeds. Old machinery was sold for proceeds of $45,200, and new machinery was purchased. Apparently there was no equipment purchased, but we'll reconcile that just to make sure. The share capital, there was new share capital issued for cash, so it went from 204 up to 244. We can see that that is going to be a financing activity. And then cash dividends were declared and paid. We don't have a dividends payable account anywhere here, so the amount of the dividends will just be the $49,000. If we had a change in dividends payable, we'd have to do a full reconciliation of the opening dividends payable to the closing dividends payable, but we don't have to do that here. So given all that information, let's get started on the statement of cash flows. We need to put in the title. That's always something I forget, so it's always a good idea to put it in first. And then let's put in some headings. So we're going to put in cash flows from operating activities, and then cash flows from investing activities, and then cash flows from financing activities. We will be putting a number of items in between, and then we'll come up with a net cash inflow for each of them. And then at the end, we have to do the standard cash reconciliation. So that the first heading is net increase, decrease in cash, and then we have cash at the beginning, and that reconciles to cash at the end. And that's pretty much all we can build into the calculation at this point. So then we'll get started with the operating activities. The operating activities, we start with net income. Well, we're not actually given net income, but let's assume it's income. I guess we don't really know for sure. If it turns out it's a loss, then we'll have to change the heading here. But we'll start with net income. And let's take the revenue number. So the revenue number, the other expenses, and the two depreciation expenses. Those are all the expenses. So revenues including gain, just the December 31st, 2015 column, because of course this number would have been closed to retained earnings last year. So start with revenues of $764,400. Subtract other expenses, $730,000, $730,000, and then subtract depreciation, and there are two of them, $6,100 and $8,300. So our net income is $20,000. And then the next line is the adjustment to reconcile net income to cash provided by operations. And then we have to adjust for, well, the standard one is depreciation. Whoops, wrong button. Depreciation expense. If we type in DEP, that'll get us there. And we can include both of them here, 6100 plus 8300. And of course, we're adding that back to undo the impact, the net income. We're kind of assuming it's all cash. We know that's not true for depreciation expense, so we've deducted depreciation expense from net income. We need to add it back to undo its impact. Now we're going to need to calculate gains and losses on sale of equipment, and so that, well, no time like the present, I suppose. So let's see what we can do to do that calculation. You'll need a spreadsheet, so if you go up here to the lyrics header, you'll click on spreadsheet, or you can do an Excel spreadsheet if you like. I'm just going to do it in lyrics so that it's all kind of self-contained. We're going to talk about equipment first. Now we need to build a calculation so that we have a cost column and accumulated, well, let's say minus accumulated depreciation column, and then the next column will be net book value. And along this side, we're going to have an opening balance, and then we're going to add some stuff. Actually, let's remove the open here and then erase that. And then we add a couple of pieces, and that will include depreciation expense. That will be added to the accumulated depreciation. And then if we purchase any new assets, that will go there. And then we subtract any assets which have been sold, and that will give us our closing balance in each of these accounts. And then over here we need to calculate gains or losses, so let's put that in here. And we do that as follows. We start with proceeds, and we subtract net book value, which we're going to get from the reconciliation over here. And that will give us, if it's a positive number, it's a gain. If it's a negative number, it's a loss. For some reason, we're kind of being squeezed here a little, so let's make that a little bigger so we can see the whole thing. Now, some of these numbers come straight from the trial balance. So we have an opening balance in the cost of equipment. That would be the 119,000. The closing balance in cost is 13,500. So we can put 119,000 here. And now we need the accumulated depreciation opening number, which is for equipment $75,000. So 75,000. And that means that the net book value is the difference between those two, like that, 44,000. We know the closing balance as well. So the closing balance in equipment is 13,500. That's the cost column. And then our accumulated depreciation on equipment is 1,600. Wow, that's not very much. Must have sold a lot of equipment. And then the net book value is the difference between those two, again, 11,900. Now, we know the depreciation expense doesn't affect the cost column, so that's always 0. And we know that when we buy assets, we never buy accumulated depreciation, so that's always 0. So depreciation expense can be filled in here. We have that. Depreciation expense on the equipment is 6,100. So put that in here. And of course, that increases the amount of accumulated depreciation. But if we take the cost minus accumulated depreciation effect, more depreciation decreases the net book value, which I think makes sense. Now, let me tidy up here just a little bit, if I can. The information we've been given includes the fact that equipment was sold for cash of $24,800. So the proceeds go here. $24,800 was the proceeds amount. And we need to reconcile these equations in order to determine the cost and accumulated depreciation and net book value of the assets which were sold. And we need to do that because we need to figure out what the net book value of those assets were to calculate the amount of the gain or loss. So it doesn't tell us anything about purchases, so let's assume the purchases were 0. It does tell us about purchases for machinery, so we'll do that in a bit here. But now we need to do the calculation to find the missing pieces. Now, if you hit the Shift key and hit any of the arrow keys, up and down arrows, side arrows, That'll actually move this box, so that moves it out of the way, so we can actually see the calculation. The calculation goes like this: 119,000 plus 0 plus 0. That's our estimate of what the number should be at the end of the year if there were no sales. And then we subtract the actual amount in the ending balance, if I can get the numbers entered correctly. 105,500, it says, was the cost of the assets that were sold. Now we want to be subtracting those, so let's put some brackets around that expression and put a minus sign in front so that it shows as being deducted. So now in depreciation, accumulated depreciation, we do the same thing. Once again, I'll move it out of the way so we can see. 75,000 plus 6,100 minus 1,600. So the 75 plus the 6,100 part gives us an estimate of what we expect the number to be in the closing balance. If there were no sales, that's what it would be. But there were some sales, so we subtract that, the actual of 1,600, and that tells us approximately how much the balance went down because of the assets which were sold. Once again, you don't have to do this if you don't want to, but I like to do it because it makes it a lot tidier. And now, if we go minus 105,500 minus a minus 65, 100, whoops, 100, that tells us what this net effect would be. Yeah, okay, we missed a 0 there. That makes a little more sense. So the minus 89,900, something looks a little weird here. 119, 75, 13,5. Wow, we lost a lot of money. It looks like 13,500. Interesting. That is a very large number. Okay, so let's check over here. Making me a little worried now. So if we take 44,000 minus 6,100 minus 89,900, that gives us the wrong number. So we've done something wrong here. $119 minus 105, that does look like this one. 75 plus 61 minus 65. That doesn't look like it's the right number. So let's see what we did here. 75,000 plus 61. Oh, we've got too many zeros there. Okay, so that makes a little bit more sense. So 75 minus, okay, let's change this number now. 115,100. Well, boy, I really typed that well. So 105,500 minus a negative 79,500 gives us a negative 26,000. And then let's see if that works. 44,000 minus 6,100 minus 26,000. It doesn't work, indeed work to 11,900. So you kind of have to play with this to make sure it all works, right? That minus that gives us that. That plus that minus that gives us that. And then over here, the final column, take that column minus that column gives us this column. And then when we add it up, it should give us the same result as the cross calculation here. Anyway, the 26,000 then is the net book value of what we sold. We can put that in here, and then we can calculate the amount of the gain or loss as 24,800 minus 26,000 is a negative 1,200. So we need to put that into our cash flow statement. All of these calculations were done to result in that number, and that is a loss. So here on the cash flow statement, we want to write loss on sale of equipment, and that is indeed what we have here, and it's 1,200, and we're going to add it back because it's been deducted from that income. We need to add it back to undo the impact. All right, moving right along then, let's do the same thing for machinery. I won't force you to sit and watch me do that, so let me clear it all out, and I'll be back in a second. Okay, now we're back. We've blanked everything out. And now we're doing machinery instead of equipment. We need to fill in the numbers from the balance sheet there, the other numbers from the balance sheet there, and then we need to determine, again, what the net book value of what it was that we sold actually works out to be so that we can calculate the gain or loss. So now we're looking at the information here in line D, and it says old machinery was sold for cash of $45,200. So we can plug that in here right away. And it says new machinery was purchased for $21,000 cash. So we can put that in here, $21,000 cash, and of course the net book value would, you don't buy accumulated depreciation when you buy a new asset, so $21,000 increase in net book value as a result. So that takes care of that information. Now we need to go down here and find all of the machinery related items. So we've already taken care of the equipment. We're going to have to reconsider. We've taken care of the depreciation expense for the equipment and the accumulated depreciation for the equipment. Now we need machinery, depreciation expense, and accumulated depreciation for the machinery. Let's bring our spreadsheet back. So now we have an opening cost in machinery of $117,000. So $117,000 goes there. If you just hit tab, it'll take it to the next space. So the accumulated depreciation on the machinery, the opening balance is $35,000. And then the net book value would be the difference between those two, like that. And then we have the closing numbers as well. So the cost closing number for cost is $56,600. And then the closing value for accumulated depreciation is $5,900, indicating we've sold quite a bit of assets. And then the net book value is the difference between those, and we'll check to make sure it reconciles in a bit. So feel free to fill in the numbers. Now, depreciation expense for the machinery. So we've got accumulated depreciation and machinery costs taken care of. Now we need to include the depreciation expense in the machinery, which was $8,300. And then 0 minus $8,300 is the effect on net book value. So now we need to reconcile these in order to figure out what the net book value was. We could actually do that with only this column. So let's do that. Take 82,000 minus 8,300 plus 21,000 and subtract 50,700. It says that the net book value of what we sold must have been 44,000. So once again, I like to do the brackets and the sign so that it shows the correct direction. That's going to be deducted from 45,200. So the amount of the gain is 45,200 minus 44,000. Now we can fill in the rest of these accounts to show that it actually does reconcile in that way. But the number that we need for our cash flow statement is this number here, the 1,200. So let's put it here. Just a moment. I'll give myself a little bit more room because we're going to have a bunch of non-cash working capital things to fill in here. So it's a gain on sale of not furniture but machinery. And in that case, we want to deduct the 1,200 because we added it into net income, but it's not the amount of cash we received. So we want to undo the impact of the gain on sale. Now, if we were to go through the process of checking to see what the remaining missing pieces would be, we can go like this: 117,000 minus, plus 21,000 minus, get down there, 56,600. That shows us that the cost of the assets we sold were 81,400. And for this one, once again, move it down so you can see. Put in a minus sign, and then 35,000 minus plus 8,300. Depreciation makes our accumulated depreciation go up, and then we subtract 5,900. And so if we check to see whether that balances across 81,400 minus 37,400 does indeed work out to a net book value of 44,000. So that's all to show you that it does in fact reconcile. You wouldn't have had to do that because we had enough information to do this net book value calculation and calculate the net book value of what was sold to put into this equation without that information. Okay, so that takes care of our spreadsheet calculations. And now we can go to the changes in our non-cash working capital accounts. So that would include on our trial balance here, the accounts payable, accounts receivable. Let's click off the machinery ones here. So we've taken care of machinery, depreciation expense on the machinery, and accumulated depreciation on the machinery. So let's see what else is left over. We've got accounts payable, that's current liabilities, accounts receivable, current assets. Allowance for doubtful accounts is a contra account for the current assets, accounts receivable. So we're going to have to consider those when we do the change in accounts receivable. Cash is the reconciliation at the bottom. Dividends are part of financing activities. It tells us that the cash dividends were declared and paid here. And merchandise inventory is a current asset, so we're going to have to include that. Long-term notes payable, financing, retained earnings, that's the dividends reconciliation. Share capital has increased by 40,000, so that's a financing activity. And then unearned revenue is a current liability. So all of the current assets and current liabilities need to be adjusted here. Okay, so we're back, and we are going to do the changes in the net working capital account. So let's start with accounts receivable. We don't know for sure whether it's going to increase or decrease, so let's just hold off on the sign. Let's do the calculation first. So accounts receivable is comprised of that number and that number. So the accounts receivable of 58,000 minus 7,000 is the opening number. And so the way it works is when we collect the accounts receivable, that increases our cash. So we can start with 58,000 minus 7,000. That's the opening number, and that will increase our cash. And then, of course, we lend our customers some money for the closing balance. So the opening balance is what we collect from our customers. The closing balance is what we lend to them. So 65,800 minus 4,800. So overall, cash went down by 10,000. So now we know when cash goes down, that indicates that the accounts receivable increased. So we have an increase in accounts receivable. Now to show that that's the case, let's look at merchandise inventory. Here we have a decrease in merchandise inventory, so we can actually put that in. Whoops, I did that once before as well. So there we go, decrease in merchandise inventory. And so the way that works is we have an opening balance of 52,000. It's as if we sold the opening balance and got the cash and then bought some new stuff. We bought 46,780 of new merchandise inventory. So our cash went up by $5,220. So we've taken care of merchandise inventory. Okay, that's all the current assets. Now let's go to current liabilities. We have accounts payable up here. So accounts payable has increased. And there it is, increase in accounts payable. And the way to enter this one is we paid 77,000, the opening balance, and then we borrowed back 90,920 from our suppliers. So that increased our cash. So a couple of ways to look at it. Increase in the current liability increased our cash. So an increase in accounts receivable would decrease our cash. An increase in a current asset decreased our cash. A decrease increased our cash. And so then we scan all the way down. And at the very bottom, we've got unearned revenue, which is a current liability, as you all are quite familiar with. And this one decreased. So we have a decrease in, way down at the bottom, decrease in unearned revenue. We basically paid off 31,000 and then borrowed another 29,260 from our customers in this case. So 1,740 is a net outflow of cash. So an increase in a current liability gave us an inflow of cash. An outflow of cash is accompanying a decrease in a current liability. So it should make sense. All right, so now we have to do a calculation of the cash flow from operating activities. We've taken care of all of the current assets, all the current liabilities. We've adjusted for the things which shouldn't have been on the income statement if we were looking at the cash effect. So we've undone depreciation, undone the loss, undone the gain. We're all done the operating activities. So now let's add it all up. So we start with 20,000 and add 14,400 and add 1,200 and then subtract 1,200. Let me move this out of the way so it's not pushing our screen around. and then we subtract 10,000. Get enough zeros, and then we add 5220. We add 13,920, and we subtract 1740. That works out to 41,800. We need to do the calculation first because we don't know what's a net cash inflow or outflow. But now we know it is a net cash inflow from operating activities. Now let's move on to investing activities. Now investing activities, we had the two spreadsheets, but we have information